this is Bilal Haider, and in this video part I'll be going to explain a forex hedging strategy which I have got from my one YouTube follower, and I have improved it a lot, and it turned out to be very profitable. Okay, it's a forex hedging strategy, and it's very profitable, that it never ends up in loss, it always ends up in profits. Okay, so now let me go ahead and start explaining it. Okay, so now what I have written here, I have drawn this this line, this black line here, which where we will start placing our trades. This pink line here shows our take profit for our first trade if it's a buy, and this this pink line shows the take profit if it's a sell. Okay, and this black line shows the SL value for our buy trade, and this black line shows the SL value for our sell trade if we will place a sell trade here. Okay, so all the trades will have 10 pips take profit value and 20 pips SL value. Okay, so now let's start with the buy order blindly. Okay, let's go ahead and place a buy order blindly. Okay, so as soon as we have placed a buy order here, and we have decided that we will take a 10 pips take profit for this, and we will take a 20 pips SL for this. Okay, so let's go ahead and place our buy trade, and if our buy trade hits our take profit value here, we will definitely earn 10 pips take profit, and that will be fine. Okay, what I want you to do here, that when you will place a buy trade at this time, you have to place a sell stop below 10 pips here. Okay, when you will place a buy order here, you will place a sell stop order below here, 10 pips. Okay, if market goes in your favor, and if our buy trade hits our take profit value, we will delete our pending order at the time when it will hit our take profit value, and we will start again. We'll place a buy order again, and we'll place a sell stop order again, and we'll start again. Okay, if our buy order doesn't hit the take profit, and the market goes against us, and it activates our sell stop order, which we have placed here at this time, at this price, at this level, it should place a buy stop above 10 pips, above 10 points here. Okay, at the same time it activates the sell stop order here, it should place a buy order here. Okay, if market goes in our favor in this time, we will end up with having 10 pips take profit for this sell trade, and we will end up with 20 pips SL for our first trade. Okay, stick with me. Okay, I will be explaining the lot sizes for these trades after some time. Okay, now let me go ahead and explain the strategy in complete, so then I will move on to the lots. So if market didn't hit or take profit in this case as well, and market goes up once again, and if it reaches this level where we have placed our buy stop order, and if it activates that buy stop order, and that buy stop order becomes a market order here, at the same time when this buy stop order becomes a market order, it should place a sell stop order below here. Okay, at this level, and if it goes in our favor, and if it hits take profit value, all the previous trades must be closed. They will be closed, because our buy trade will hit the take profit, this buy trade will hit the take profit, and this sell trade will hit the SL value. Okay, so all the trades will be closed, and we should delete our pending orders. when any single trade hits the take profit value, or all the previous trades must be closed and all the pending orders must be deleted. Okay, and it should continue doing that. If market is swinging, it should continue opening buy stops and sell stops until we reach a take profit take profit value, either this one or this one. Okay, so now let's move on and let me tell you about the lot sizes of these trades. The first trade we will place, that very buy trade in our case, will have 0.1 lots. The sell stop order which we have placed below 10 points will have 0.4 lots. Market goes against and it placed a buy stop above here. Okay, this order is activated and we placed our third order, which is buy stop, will have 0.9 lots. And our next trade, our next pending trade will have 1.6 lots, and the next will have 2.5 lots and 3.6 lots. If you will see these lot sizes, and if you are clever enough, you will see that they are squares of your natural numbers. Okay, 1 square equals 1, 2 square equals 4, 3 square equals 9, 4 square equals 16, 5 square equals 25, 6 square equals 36, and so on. You have to increase your lot sizes by that number, that square of that number. Okay, so let me go ahead down here and let me tell you how you will get profit all the times. If you have placed your first buy order here, and if it hits your take profit value, it will give you $1 profit. Okay, if a market goes in against you, and if it activates your second order, which is of type sell stop, and if it activates and if it goes in profit, if it ends up hitting your take profit value, you will get $2 profit at the end of this cycle, because your first trade will hit your SL. You will get $2 loss for that first order, but your second order, which was having 0.4 lots, it will hit 10 pips take profit. You will get $4 profit for that, end up with $2 profit. 4 minus 2 equals 4. Oh, sorry, equals $2. Okay, in our third case, if our first order will hit take profit, our second order will hit SL, our third order will hit TP. So $1 profit for first trade, minus $4 for second trade, and plus $9 for third trade, we are ending up in $6 profit. And you can see here in our fourth case, we also end up in profit. In our fifth case, we also end up in profit, and so on. We will continue doing that until we end up in profit. Okay, so you need a high balance to use this strategy. Okay, you must keep in mind. Okay, there are two tips for you. When you will be placing your first trade, I suggest you not place it blindly, because we always want our first trade to hit our take profit value, or we don't want to move further than 5, maximum of 5 trades. Okay, we don't want that. But if it goes, no problem. Okay, even if it goes above 10 trades or even more than that, no problem at all. Okay, no problem. So, and the next tip for you, okay, the first tip is that you place your first trade based on some indicators like moving average. Okay, moving average is very cool indicator. Like if moving average is below your current value, you should place buy order. Okay, if moving average is above your above your current value and you are going to place a trade, you should place a sell order. Okay, and there are lots of other indicators. You can watch my videos to know more about more indicators there. And the second tip for you is that you should choose a broker with the lowest spreads. Okay, you should be choosing a broker with maybe one pip spread or maybe 1.5 pips spread. That will be fine. Okay, so this was the strategy which I wanted to teach you, and if you will learn this strategy, you will definitely earn profits. Okay, so I hope you have learned something, and keep watching my videos. I will be converting this forex. Well, by the way, if you wanted to take an expert advisor from this strategy, you should contact me on my email address, which is Bilal, BILAL _ HAIDER Haider 032 @yahoo.com. Okay, you can contact me on my email address, and I'll be providing you the expert advisor that I have created from this strategy, and you will see its results. Maybe I will be posting its results in next some days, or maybe I'll be posting those results on my YouTube channel. Okay, so if you wanted that expert advisor, you can always get that from me. But if you want to use this strategy, you will be in profit all the time. So thank you for watching my video.
Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in today's video, I want to talk about pairs hedging. So when I'm looking to place new or adjusting trades or hedge trades, I will often use similar or correlated underlying stock to hedge other positions in the same sector or industry. Now, this is a little bit different than what we talk about when we mention in some other videos about the fact that you should have uncorrelated securities in your portfolio, and that generally holds true. You don't want to have too much oil, stocks or ETFs, too much financials or social media or utilities. You want to have a lot of different securities in your portfolio because you want to be diversified across the market. But when it comes to specifically hedging individual trades, and if you're looking to make an adjustment or a hedge, sometimes I won't make an adjustment to that actual trade, but I'll make an adjustment that I would make in that trade on another correlated or related industry or sector stock that's trading. So for example, if I have a position in RIG, which is RIG, and it's an oil related security, then I could use that to hedge another position in USO, which is the US Oil Fund and ETF. Again, if I have GLD, which is a gold ETF, I can use that to hedge another gold ETF, which is GDX. If I have a Facebook position, I can use that Facebook position to hedge something in TWTR, which is Twitter. So you can see that we're using very similar or underlying stocks to hedge some of our trades. So in this video, I want to walk through how we can do that with a current position that we have in HAL, which is HAL, it's Halliburton, and an oil-related stock, and how we can use XOM, which is ExxonMobil, as a hedge for this position. So on our broker platform here at Thinkorswim, you can see I've kind of opened up this trade here in Halliburton, and we had sold a credit call spread above the market that's currently a little bit against our position. So the stock is rallying a little bit. We have the 44.45 call spread above the market, and the stock right now is trading at almost 41. So it's starting to lose just a little bit of money. We're down about 19 bucks on this trade overall. So if I wanted to go ahead and hedge this position, the first thing I need to do is figure out just what are the deltas of this position. So I can see here on my chart that I've got a delta of this position of negative 1282. So what this means is I really need Halliburton to go lower for this position to stabilize. And that makes sense, right? Because I'm selling a credit call spread above the market And in order for me to make money, the market has to stay below my short strike, which is the 44 call. So that makes sense that my deltas are negative right now. So if I want to neutralize this position or try to hedge it, I need to look for something that has some positive delta to kind of counterbalance this negative delta that I have. Now here's the problem. How do I know how much delta ExxonMobil has relative to HAL? So they're not exactly correlated, but they're in the same industry, so that's good enough. But I need to know specifically how much of ExxonMobil I need to trade to hedge this position in HAL. Now, one of the ways that we can do this is with what's called beta weighting. So right up here inside of our portfolio, we check the box for beta weighting. And in this box here, we can hedge any of our positions below to whatever symbol we put in this box. So in our case, we're going to just type in XOM. And what that does is that now is going to beta weight all of these positions to ExxonMobil. And so it's going to relate everything and make them correlated to ExxonMobil. And now you can see that the delta of this position has now changed to negative 10.26. So that means that as it relates to ExxonMobil, this position would need to have about 10 positive deltas in an ExxonMobil trade to hedge it. Okay, so again, this Halliburton position has now been converted apples to apples to compare with ExxonMobil. So now what we need to do is find a position that has 10 positive deltas. Now what we're going to do is, because one of our first adjustments to a credit call spread is to sell the corresponding put spread below the market, is we're going to go out to ExxonMobil here, and we're going to go to the same contract month. So we're dealing again right in ExxonMobil, it's currently trading at 92.5. We're going to deal in the same contract month as our Halliburton trade, and we're going to sell a put spread below the market, trying to get somewhere around 10 deltas. So in this case, we'll just start off with the 85 and the 82.5. And you can see that selling that put spread right here gives us an extra $31 credit, which offsets some of the loss that we're starting to see in Halliburton. And more importantly, right here in the Analyze tab, you can see that the delta of this new position is 5.49. So this is only doing a one lot position. We have a 5.49 delta. Now that is going to hedge part of the position, but remember, going back to our monitor tab, we need a delta of about 10 or a little over 10 to completely kind of neutralize or protect this position. So here's what we need to do. We need to sell one more additional spread in this trade. So I just moved the quantity up to 2, and now by doing that, you can see that the delta is actually a little bit higher, but it's never going to be perfect. It's about 11 positive deltas. So if I was to make this trade, this would almost exactly hedge this position and re-neutralize the deltas by using ExxonMobil as it relates to Halliburton. So again, the big benefit to doing this is that I'm sometimes able to get much better pricing on something in a corresponding ticker in the same industry, like ExxonMobil or USO or GLD. Plus, this also increases the level of diversification among stocks in our portfolio. So now we don't have additional positions in Halliburton. Now we have that position split, and it's delta neutral, but it's across two different stocks that are in the marketplace that are very similar correlated. So it increases the level of diversification in our portfolio and the number of trades that we make. So hopefully this has been a really helpful video. I know this is a huge topic that most people ask about. If you have any questions or comments about pairs hedging, please ask them right below in the video lesson section. Until next time,
everyone, this is Kirk here again at optionalpha.com, where we show you guys how to make smarter trades. Tonight we're going to go over all of the trades that we made for December 1st. Can't believe it's already the last month of the year, but hopefully you guys had a really nice holiday. I know I emailed back and forth with a bunch of people over the holidays, but hopefully everything was good, and it was good to enjoy both time off work and then also time with family, always important. Today we had a pretty active day with adjustments, kind of cleaning up a lot of stuff as it relates to oil because of the huge move lower that it had on Friday of last week. So Friday was a short trading day, but just because it was a short trading day, it was definitely not absent from activity, especially in the oil markets with the announcement from OPEC on supplies, and oil just took a nosedive. So we spent the better part of today just kind of cleaning up positions, taking some profits on some positions and kind of readjusting others to make sure that we're covered in case oil does go lower. So that's what the bulk of tonight's video is going to be on, is how we kind of went about going through and adjusting some of these positions. Now, if you were part of the premium membership, we actually talked through a lot of this stuff that we already did today last night on the strategy call that we do on Sunday night. So if you kind of want a little bit of an inside edge on what we're doing kind of ahead of what the alerts come out with, you got to sign up for a premium membership, because we did talk about a lot of this stuff last night with the call with those premium members. So the first one that we're going to go over today is just really quickly the closing trade that we had in COP. COP's ConocoPhillips, and we had originally sold the December 72.5, 75 call spread and sold that with the intention that this is a hedge. So you can go back to the video tutorial that we did that day that we had actually entered that order. This was intentionally doing a call spread against our positions in oil because we wanted some sort of a hedge as oil, possibly went lower. Well, as oil did jump lower, ConocoPhillips gapped lower, and so obviously the 72.5, 75 call spread basically became almost worthless. So we bought it back today for a 10-cent debit. There's really too much risk left on the table. It did exactly what we needed to do, so there's no use in kind of letting it go for another $30 before commission. So we took a nice little profit on that hedge just to kind of help out in the other oil positions. When you see ConocoPhillips, you can see this is kind of the story with a lot of oil stocks that had a huge move lower on Friday last week, and most of them actually regained their balance some today. And I don't know, if this means that we're going to continue higher or if it's just, more sideways action, but a lot of them that were down early, XOP, USO, PBR, etc. A lot of these stocks actually had a really nice run into the close, which is really kind of boding well for possibly some, a little bit of market reversion or stabilization. Whatever the case is, in the case of COP, we did decide to go ahead and take profits on that side of the trade. Then with other trades that we made, so we start getting into some of the adjustment trades that we did. The first one that we did today is the rig adjustment. Again, this is one that we talked about with members on the call last night. Rig is another oil-related stock. So what we decided to do is go into something a little bit different, get away from USO, XOP, etc., and just go into something that's related to oil that we can, again, kind of replace our COP trade that worked in our favor. So we want to do the same basic thing with COP, but just doing it with rig. Now in this case, we did a little bit different because it's a $2 wide strike versus a $2.50 wide strike. We had to sell just another contract versus the 3 that we bought back on COP. So you can see it's very systematic the way that we're going about this. So there's no, we're not trying to, just kind of whimsically throw trades out there. We're very systematic about how we're making adjustments. And this rig trade is a replacement type of trade to COP that we just closed out. And that's why it was a little bit higher in contracts, because the spreads were a little bit narrower. So we had to take in more of that spread. Now we also talked a lot about deltas last night. I don't want to get too much into that in today's video tutorial, but those premium members who were on that, we talked a lot, probably about 15 to 20 minutes just on kind of neutralizing deltas and being delta neutral with your trading. So for RIG, we did sell the 2022 call spread, and we did that for an 84-cent credit. So pretty hefty credit. And again, the whole idea here with rig is that we wanted to, again, take advantage of possibly a continued move lower in oil. And if oil does continue to move lower, we need some sort of a hedge above the market to kind of counteract the positions that we have right now. You can see that rig has almost 100% implied volatility right now. So it's a great candidate because it's in the oil sector and it's got really high implied volatility. So we're just going to play it to the downside. Thankfully, actually, rig was one of the ones that actually continued to move lower today, whereas USO and XOP kind of rallied off the bottom. So it was really interesting. The hedge kind of worked out a little bit better in our favor. And then the other adjustment that we made, and then we'll get to X, is in XOP. So XOP, via a vertical call spread, we decided to roll down our 55 calls to 49. So again, don't get too confused on the actual order. We just entered a vertical spread order, but remember, a vertical spread is selling that front contract or the 49, buying the 55 contract or the back contract, but we were already short the 55. So when we bought it, we actually bought back our short 55 call, which is basically worthless at this point. So it was serving us no purpose at all. So what we did is we rolled down to the 49 call. That combination took in an additional $1.90 in credit, which helped move our break-evens out just a little bit further. So here's what XOP looks like. And again, we'll kind of go through this here on the chart. But our 55 was right here. So our 55 calls were right about here. And you can see as XOP moved lower, then what we did is we decided to roll down to 49. So we rolled these calls that we have here at 55. We rolled them closer to the market to kind of rebalance the position and kind of recenter it as much as we could over the market. Now, it had a nice little rally off of the base today, and that's okay. That's kind of what we wanted after we made this adjustment. If we actually go here to the Analyze tab, you can see that our new position in XOP looks like this. And again, this doesn't take into account any other adjustments that we made previous to this. It's just the two trades that we have right now, which we are short the inverted strangle, the 67 put, and the 49 call. So the 67 put is all the way over here, and the 49 call is all the way over here. Ideally, all we want is we want XOP to trade somewhere between that range between now and expiration. You can see it rallied up just a little bit today, so this was good. This kind of recentered our trade. If we can get XOP to continue to trade somewhere in that range, then we should be good to go until expiration. So we'll see what happens, and we'll obviously make adjustments along the way. The last two trades that we made, and we kind of made a very similar type trade as XOP here. We just did them in two separate orders, basically, with X, which is US Steel. So US Steel continued to move lower, again with oil as well. So we did the same thing where we bought back our short 35 calls, rolled them down to and entered or sold a separate order for the 30 calls. And we just added one additional contract here just because it was filling. It filled a lot quicker with 10 contracts, and we like the credit. So we added another $2.11 for the credit on the roll down, and then we have to subtract out the cost that we paid to buy back those December 35 calls. But now that these are separate, you can see exactly the logic behind rolling down that call side. As the market moved lower, all we can make is another 38 cents on these December 35 calls. So if X continued to move down lower, right, and we're kind of going off of that hypothesis for today, if X does continue to move lower, all we're going to make is another $38 times the 9 contracts that we were short. Well, in this case, we know that we've already made some money on those. I think we sold them for around $575 or so when we rolled them out. So we've made a ton of money on that particular side of the trade. What we need to do now is take in additional credit, because if X does continue to move lower, then we need to factor in that additional move lower. And now we're going to make $211 on this particular these particular two trades versus $38. So again, this is the reason why we're rolling down to take in more credit. Once an option has pretty much exhausted all of its money, there's no point in keeping that option on. You either close it out or roll it to a different strike price to take in more credit. And that's the whole name of the game, is continuing to roll and extend duration and extend your credits. Now with X, this is what our new position looks like. Again, this doesn't take into account anything that we did earlier in the last couple of months as far as adjustments. But if I take out this short call right here that we did, these December 10 short calls, you can see this is basically what our profit loss diagram would have looked like without those short calls. So let me just kind of narrow this graph here down. And you can see that it's really kind of centered now around 46, but really the risk is dramatically lower, right? So if X continues to move lower, which at least at this point, that's the assumption that we're going off of, then we are losing every single day that it moves lower, right? As soon as it moves to 30, we lose about $5,000 at expiration. Again, just on these options, not on the whole position, but on these options that are left, we'd lose about $5,000. So by adding this short 30 calls, you can see how that recenters, it kind of rebalances the position. Whereas it used to look like this, now it's kind of tilted, and now it's kind of moved this side of the market, or this side of the profit loss diagram down and this side up. So it's kind of reshifted the profit loss diagram. Now, if X just stays here, then we stand to make back about $3,000 of our initial position. And we would need to move down to about 28 for us to lose $5,000. So instead of X moving to 30 and we lose $5,000, now X would need to move all the way down to 28 for us to lose about $5,000. So you can see that that's why we did this and took in more credit, is we take this break-even point that used to be $5,000 here, and move it out another $2+. So it gives us much more room in the stock price and kind of the volatility of the stock, given how big of a range it's been trading in, to actually kind of stabilize the position. So hopefully that makes sense, and hopefully kind of visualizing it here on the Analyze tab really helps out. So those are all the trades that we made today. As always, if you guys have any comments or questions about these trades, please shoot us an email or add a comment right below this video. And until next time, happy trading.